In this video, I'm going to break down how futures contracts work. So let's start off with talking about what exactly futures contracts are. So the way I like to think of it is a futures contract is an agreement or a financial contract whereby you agree with somebody else that you're going to buy a specific asset later in time at a price that we agree today. Irregardless of what the price is later, we have to buy or sell the asset at the price that we agreed. So let's give an example. So let's say you're someone who wants to buy corn, and currently it's May, but you don't want to buy corn right now. You don't need it. Maybe you've got like this huge family gathering and you've got a specific recipe and you need a lot of corn. So you want to buy it in December. So you don't want to buy it now. What you would do is, if you believe, okay, in December, I'm not quite sure what the price is going to be. I think it might actually be way higher than it is today. So what you'd do is you would go to a farmer and you would make an agreement with them and say, listen, I'm going to buy your corn in December, which is what we term the expiry date. I'm going to buy your corn in December for, let's say, $50. Okay, so irregardless of what happens in December, whatever the price is in December, doesn't matter. I'm going to buy your corn at $50. So you both agree. So this can work good and bad, because if you think about it, maybe later in December, the corn is cheaper, but now you have to buy it $50 rather than, like, for example, $20. But what you're doing is you are eliminating the risk of it being like $100 because now you can buy it at $50. So that is an example of a futures contract that you would use if you wanted to buy corn and you weren't too sure whether it's going to go up or down in price. So you want to reduce your risk. So let's give you some extra information on futures contracts so that you can understand them a little bit better. So for starters, futures contracts operate with predetermined contract sizes. So what I mean by that is you can't just buy 0.001 of a corn. Okay, so when you buy a contract, usually that contract is denoted in 1,000 units. So if I buy a corn contract, it is a corn contract to buy 1,000 units of corn at a specific price. So if it's $50, then it would be 50 times the 1,000. So it would be $50,000 contract basically. Another thing is futures are determined by the expiration month. So what we mean by expiration month is the month in which we have to pay up. Think of it like if there's a gold futures, okay? So you would hear the contract for gold for December would be the December gold contract or the gold December, okay? So you are able to actually see today in May, you'll be able to see all these different contracts related to December, and the way you'll see it is it'll say gold December. So you know that that December is the expiration date. Another cool thing about futures contracts is the buyer of a futures contract can actually sell their position early to someone else. So let's say, for example, I buy a futures contract in May for December's time, and it's a specific contract. And let's say by maybe October, I don't want to continue with this contract. Maybe I think I did the wrong thing. So what I would do is I would call my friend and I'd say, listen, I have this futures contract. Do you want to buy it from me? I'll sell it to you. And then if he agrees, then I'm going to sell it to him, and now he's going to be the buyer of the contract. So what's important is when December comes, someone is going to buy that corn at that specific price. It might not be me, it might be my friend, but someone has to at the expiration date. Another cool thing about these futures contracts is they operate on different exchanges. And depending on which exchange is used, it determines whether it's going to be a physical settlement or if it's a cash settlement. So what I mean by that is, at the end of the day, when December comes, there's two types of settlements that might happen depending on the exchange. So either there's a physical settlement whereby someone will actually physically bring me the corn and I will physically have corn. Or when we mean cash settled, what we mean is, okay, so I bought this contract at $50, it's now at $65. So the difference I'm going to be given. if you get what I'm trying to say. So basically, instead of me actually receiving the corn, I'm going to receive money. Either if I was right and I bought it at 50 and it's higher, I will receive money. But if I was wrong and now it's gone to 40, now I will have to give money. So it's either a profit or a loss. So it operates sort of like any trade that you operate on a futures agreement, like a forex trade, for example. Let's talk about the different types of futures contracts. So I've illustrated a few, like I gave you corn, then I spoke a little bit about forex. So let me give you all the different types of futures contracts. So you can have commodities or you can have financial products. Okay, so what do we mean by commodities? Commodities are, for example, you've got your natural gas, your crude oil, your wheat, your corn. So those are examples of commodities. So that's one type of futures contract that you can have, which is number one, commodities. The second type is what we call stock index futures, such as the S&P 500 index. So what this stock index future is it's basically, it mimics sort of the S&P 500, but you don't actually physically own any stocks or shares from the S&P 500 index. What you actually have is you're just trading. So that's how people would trade these type of things. So they wouldn't actually physically own it, but they are trading the contract. Similar to the stock index futures are your currency futures, or what I like to term forex trading. So this is where, you can speculate that the euro US dollar is going to go down, so you short it or you sell it and you make some money. So what's important is you don't own any of the euros or the US dollars, but you own a contract. So the underlying asset is the currency, but you don't actually own it. You're just trading, or if you want to think of it, betting, speculating on that. So it's very similar to the stock index future. And then finally, we've got our precious metals. So this is, for example, things like gold and silver. So same sort of thing where we can do some sort of a contract. So before I move on to the last bit, let me just explain a little bit more about a futures contract and the concept that it is derived from an underlying asset. So what I mean by an underlying asset is it the physical asset. So for example, when I spoke about the stock index futures, like the S&P 500 index, the underlying asset is the S&P 500. Okay. So if we own the underlying asset, we would have shares in the underlying asset. But what we have is we have a financial contract that is based on this underlying asset. So it's basically like a piece of paper that you don't actually own any shares in the S&P 500. You just have a contract which allows you to trade them in the form of speculation or trading to make a short-term profit. So now let's talk about the two reasons why you would use futures contracts. So the first one is for hedging purposes, and the second one is for speculation. So let's first talk about the hedging concept. So the hedging concept is basically where you are trying to minimize your risk. It can take two parts. You either in a trade with the underlying asset. So let's say you bought physical Bitcoin, as in Bitcoin on the spot market, and Bitcoin's going down. So now to hedge your position, you would open a short position on the Bitcoin futures market, so that whatever you're losing in the spot market of your physical asset of Bitcoin, you're making up for, and you're making a profit on the way down, and you're hedging your risk. So while one thing is losing money, the other one is gaining money. So you sort of come to an equilibrium point where you're at break even. Another way that hedging is done is a corporation. For example, like I said with the corn, you aren't sure what the price of, for example, corn is today in May when you need it in December. So you engage in a contract which you agree, I'm going to buy this specific asset at this particular price later, so that now you minimize the risk of it becoming super expensive and now you don't have the money for it. So that's how hedging works. It's basically, the best way to think of it is hedging is sort of protecting your investment. So now let's talk about the second reason. And the second reason is the concept of speculation. So this is what traders do. So what traders do is they speculate on different assets, and then they will make money based on what they bought the original price at and the closing price. So obviously if the closing price is higher than the original price, they'll make money if they bought the contract. And if they're selling or shorting, obviously the closing price has to be below the original price so that they can make a profit. So basically with speculation, there's no physical settlement of any assets. It's basically cash settled. So depending on, you bought it at the original price, where is it now? Is it at the closing price? Boom. Were you correct? Was it going to go up? Okay, you were. Cool. So you made money. Or were you wrong? Okay, cool. Now pay up. So that's the concept of speculation. And what's cool about the speculation part about futures is we use this concept known as leverage. And what leverage does is it allows us to enter positions that we otherwise wouldn't have been able to enter ourselves. And then for us to be able to execute this leverage and to be able to have this leverage, we have to put down what we call a margin amount, which you can think of it as a depositor's fee. So it's something that you give to your broker to settle any transaction costs, etc., so that the broker doesn't have to pay for your losses. So that allows you to have leverage, and leverage allows us to make a lot more money than if we just had a normal small amount and we're trying to engage in an underlying asset. So this allows us to have a bit more power so we can make a lot more money. So now we're going to move on to the whiteboard to show you an example of a trader who's speculating on the crude oil price. Now, what I want you to remember is the concept of leverage, whereby this trader only has to deposit a small amount of the contract. Maybe let's say $5,000 he would give to the broker, which would be the margin amount. But then he can operate with leverage, and he can operate at a contract which is much higher. So for example, he can operate at a $50,000 buying power just by giving his little deposit fee of this $5,000. Okay, so let's use the whiteboard to show how a trader would speculate on the price of crude oil. So firstly, we've got our little trader, and he's obviously very happy because he's about to make some money. Cha-ching, right? So this trader wants to speculate on the price of crude oil. So currently it is May, and this trader reckons that by the end of the year there's going to be an increase in the price of crude oil, so he wants to make some money. So what this trader is going to do is he's going to go to, let's say there's this big board with all these different prices, and he's going to look for the December crude oil futures contract. So he's going to look for it, and let's say it's here, and let's say that the December crude oil contract is $50 currently. Okay, so as of May it's $50. Obviously as we progress, maybe in June maybe it might be 51 to buy it, then July might be 52. Okay, so he chooses the December contract, and remember what we said, it would actually be called the December oil contract. This is what he would be purchasing. Okay, so let's say our figurative trader purchases this December oil contract for a price of $50. So what this trader wants to do is this trader wants to make money. Okay, so this trader is betting that by the time we come to December, this price is going to be bigger than this $50. Now what's important, as I said previously, is that when you buy an oil contract, it's usually standardized. Okay, so what that means is you have to buy a whole bunch of these contracts. So in this case, you have to buy 1,000, because that is one contract is 1,000. When you are buying a contract for $50, in effect, let me just rub this out. So when he is buying his $50 contract, he is buying 50 times 1,000. Okay, so that means that he is going to be buying these contracts for $50,000. Now, what's really cool about futures contract is this trader doesn't have to pay all of that amount. He doesn't have to use $50,000 of his own money right now to purchase the contract. This is where the concept of margin comes in. So maybe the trader would only have to put down 5K as the margin, let's say. So he's saying to this futures contract, I'm going to buy this contract with $50,000 for $50,000 in May. And remember, the concept of a futures contract, if we're buying it in December, means that once December time comes, we have to, which is our expiry date, this is when we have to buy the crude oil. So now what's important about this margin before we move on is maybe as we progress through the months, the broker might require more money. So it might say, okay, I need you to bring me 6K, 7K, etc. The margin might increase if, for example, this $50 goes down to 49 or 48, because the broker isn't going to pay for your fees. The broker is going to ask you for more money to keep your account still open. Obviously, this isn't the exact number. I'm just using different ones. So this 6, 7K isn't based on this price. I'm just throwing random things around. Okay, so now let's say by December time. So now we're in December. And now we look at the crude oil. And let's say that now the price is now $65. What has this trader done? Well, he secured the price at $50. So he was right. He speculated that the price was going to increase, which it did. It went from $50 to $65. What's important about the speculation is there's no exchange of oil. So there isn't oil coming. We're not collecting any oil. What we are doing is we're just going to collect the cash. So this is a cash settled contract. There's no physical delivery, okay? The way the profit would be, it would be the $65 minus the 50, which would give me 15. And then remember that we have contracts of $1,000. So it would be 15 times 1,000, which would be $15,000. So this is the amount that the trader would make profit. So the broker or whoever would be paying this trader $15,000. Now, obviously, I haven't taken into account transaction fees or any of that. Okay, so this is just pure, 15 times 1,000, 15,000. But obviously, there will be transaction costs, etc. So it won't be a pure 15,000. It might be 14,900, whatever, depending on the transaction costs. So now let's rub this out and let's try and talk about the opposite scenario where this time, let's say that the price actually dropped. So now let's say that December time comes and now instead the price has dropped to $40. So this trader who bought the contract at $50 was wrong. A sad trader, because he thought he was making money, but he actually was very wrong. So again, we use the same formula. So what we do is we say 40 minus the 50, which gives me 10. And then remember, it's 10 times 1,000 contract. That's a minus 10, quick maths. So in effect, what would be happening is the trader would have made negative 10K, i.e. he would have lost that, so he would have to pay up. So that's the amount the trader would lose. So the trader thought he was a very clever man and he ended up losing money. So it's the equivalent of him just going to the blackjack table or the roulette and just betting 10K. So he just said, you know what, I'm going to put $10,000 on the black, and it went to the red. So he lost his $10,000. So he might as well have just done that. And yeah, so that explains the concept. So I've shown you how to do it when the trader's right and he's making money and he can go buy his fancy hotels, and the other scenario where he should have just gone to the casino. So that's the end of the video. Thank you so much for watching. And if you want to understand the different types of orders that you can do in trading, you can find that video right over there.